Next speaker who is going to present is Brian Sigritz. Brian is the Director of State Fiscal Studies for the National Association of State Budget Officers in Washington, D.C. Within NASBO, Brian's responsibilities include tracking and analyzing tax and revenue trends, as well as handling NASBO activities related to transportation, public-private partnerships, energy, and disaster response issues. Brian also monitors the fiscal health of the states and edits and produces a state expenditure report annually. So with this, Brian, you can start your presentation if you're ready and start sharing your screen.
Great, thanks so much. Trying to load it up here. All right, hopefully everyone can see the slides all right and can hear me fine. Yeah, thank you for having me here today. Leah gave a really good overview of what's happening on the federal level and how it's impacting states. I'm going to focus a little bit more on state fiscal conditions and what's happening with state budgets. But of course, right now we're at a time period where you can't talk about state budgets without talking about what's happening on the federal level. The federal funds have been very instrumental in helping bolster state spending and helping to lessen spending cuts and helping states to get through this pandemic, not unscathed, but lessen the harm to state budgets and overall state fiscal conditions. This has been a challenging time for states, and you know, states have had to take numerous actions, and it's really been you know, a lot of ways what states have been experiencing now is, you know, different than previous recessions. So they've kind of had to adjust their thinking somewhat on what courses of action to take. So I'll try to go through a little bit of what states have done, what's going on with states, and also talk about the outlook for states moving forward. So what we saw in fiscal 2020, so last year, fiscal 2020 for most states ended on June 30th, 2020. We did see declines in state revenues in fiscal 2020. That was the first time we saw declines in state revenues for 9 years. So coming out of the Great Recession, where we had 2 straight years of revenue declines and we had 9 years of growth. And then we did see declines in fiscal 2020, even though the pandemic really only impacted state revenues for that last quarter, fiscal 2020. States anticipated that we see sharp revenue declines in fiscal 2021. A lot of states in the spring and early summer of calendar year 2020 were reducing their revenue forecast, some instances up to 20%, you know, anticipating the you know, the strong economic decline resulting from the pandemic. What we ended up seeing was a lot more modest revenue declines, and in many instances, no revenue declines for fiscal 2021. There's a number of factors for that. One is because of the federal stimulus funds that were provided for states, both direct aid, but also aid to individuals, things like the unemployment insurance increases, some of the other pandemic assistance, loan to small businesses, all that sort of thing, helped to bolster state revenues. On the sales tax side, states were anticipating more of a decline, but we saw more of a shift to purchasing goods and products online, and states now have much greater ability to collect sales tax revenue for online purchases than they did a couple of years ago. There was a Supreme Court decision, South Dakota versus Wayfair, that allowed states greater latitude in taxing online purchases. So that's been helpful as far as sales taxes. And really the one area where consumers kind of cut back their spending on to a noticeable degree was in services. And that's an area where states typically don't tax in the first place. So another reason why we really didn't see the decline in sales taxes. On the personal income tax side, this downturn really is, you know, more heavily impacted low-income workers and low-wage workers, whereas the higher income and even some instances middle class haven't been nearly as impacted. And since states get a higher percentage of the personal income tax revenue from higher income individuals, that also helped lessen the decline in personal income taxes. So even though the revenue declines haven't been as sharp as we were anticipating, they still are down below original projections in most states, or projections made before the pandemic began. States have been impacted by the pandemic in differing ways. We really saw some of the tourism states were significantly impacted in the beginning. Also, some states are heavily reliant on severance taxes, oil and natural gases. But even those states, by and large, have now started to see a rebound. Like I said, this has all kind of been, unprecedented is, I think, been overused somewhat, but this has been unprecedented as far as some of the challenges from this pandemic. This isn't played out like a typical recession. All recessions are different, but some of the challenges associated with this one have been very different than what states are used to dealing with in a more quote unquote typical downturn, in that they're having to respond to a public health emergency at the same time they're having to respond to economic challenges in their states. Just getting a little bit more into what's going on with general fund revenue. So this is revenues from state sources, things talking about like personal income taxes, sales taxes, corporate income taxes. So you see that there towards the right, we had 35 states saw revenues come in below projections in fiscal 2020. And then in fiscal 2021, we are seeing 38 states with revenues coming in above projections. And this data was collected in the spring. When we update this data here in a couple of months, we'll be coming out with a new report in December. We're expecting that number to be even higher. So almost all states ended up seeing revenues come in above projections in fiscal 2021 for many of the reasons I mentioned earlier. We saw states use some of that surpluses to bolster their state rainy day funds, directing in some additional aid for pandemic assistance, both to individuals and businesses impacted. Also, some states were rolling it over into the current fiscal year, fiscal 2022. As far as I mentioned that revenues were still coming in below projections. You can see this here in this chart. So for fiscal 2020, revenues were at 853 billion. They're originally anticipated at 879 billion. And then for fiscal 2021, they're also about 25 billion less than what states were originally anticipating. Here again, though, when we update this data in the fall, I expect that number to increase. And if revenues remain below projections for fiscal 2021, that gap is going to narrow, but there's a chance that in the end, revenues won't even come in below original projections for fiscal 2021. So here's looking at revenue growth for the various different years. One thing, revenue collections were thrown off by the shifting of the federal tax deadline last year, where the tax deadline was shifted from April 15th to the July 15th. And nearly all states matched that delay in their own state tax collections. So we saw some revenues that would typically be collected in fiscal 2020 were then collected in fiscal 2021. So that's kind of thrown off some of the year-over-year figures. It made fiscal 2021 look a little stronger. But so you can see how it is both unadjusted and adjusted there. For fiscal 2022, states were anticipating modest revenue growth. That's sort of what we're seeing so far, where most states for fiscal 2022 so far are seeing revenues come in above projections. Not quite as high a growth as we were seeing at some points in fiscal 2021, but the state revenue environment for states is still mostly healthy as we are progressing through fiscal 2022. Looking a little bit more at general fund spending, So this compares what states enacted for fiscal 2021 versus what governors recommended for fiscal 2022. In the fall, we'll have information on what states actually enacted for fiscal 2022. But as you can see, there's much more cuts and lower spending increases enacted in fiscal 2021 than what states are recommending in fiscal 2022. Large difference in that all other category, and much of the pandemic response you'll find in that all other category. Different aid individuals, testing requirements, some of the products, masks, that sort of thing. Unemployment assistance included in all other. So a lot of the different things that aid individuals and businesses are kind of showing up in that all other category for fiscal 2022. Here's a slide on what strategies states have taken to balance their budgets in both fiscal 2021 and fiscal 2022. You can see in fiscal 2021, we had over half the states make targeted cuts. Nearly half the states did hiring freezes in fiscal 2021. For fiscal 2020, we've seen a lot of similar actions, but on a lower level. For both years, but especially for fiscal 2022, these tallies are less than what we saw during the Great Recession. During the Great Recession, for some of these strategies, we would have seen 30 or 40 states doing these sort of things, especially in the area of targeted cuts. One large reason I think for that is, there's several reasons. One is that the economy, although we saw sharp declines in the spring of last year, did start to recover fairly rapidly, partly due to all the federal COVID aid. And then the other explanation is also related to the federal COVID aid, is that, as Leah noted, the aid provided to states during this recession was greater than what states saw in the Great Recession, so they did not have to rely on these actions as much as they did during the Great Recession. This is looking at how many states made mid-year budget cuts. So we had 19 states make mid-year budget cuts in 2020 due to the pandemic mostly. That figure probably would have been higher in fiscal 2020 if the pandemic hadn't hit in that last quarter of fiscal 2020. A lot of times states' options are kind of limited to make budget cuts towards the end of the fiscal year. In fiscal 2021, when we last looked at it, we only saw 12 states make mid-year budget cuts. That figure might grow a little bit, but here, once again, we're expecting those numbers to be considerably less than what you saw both during the Great Recession and also what you saw in the recession in the early 2000s with the tech bubble burst. So, you're looking at upper 30s and around 40 states, and both of those recessions were making mid-year budget cuts. Just talking a little bit about Medicaid, what's going on there. In fiscal 2021, we saw a big increase in federal funds to states for Medicaid. This is largely due to some of the enhanced FMAP that was provided to states, and also some of the other flexibility that states have used, the COVID funds for Medicaid. In fiscal 2022, the anticipation was that states would see less federal funds increase for Medicaid, not declines of federal funds for Medicaid, but less of an increase. I think this figure will increase too as the year progresses, as states are still receiving the enhanced FMAP, and due to the American Rescue Plan, where a lot of governors, when they were proposing their budgets in fiscal 2022, the American Rescue Plan Act hadn't been passed. So they weren't anticipating on those additional funds. So with those additional funds, you're likely to see increased Medicaid spending in the federal funds category for fiscal 2022 as well. Talk a little bit about state rainy day funds. So before the pandemic hit, state rainy day funds were at an all-time high level, both in dollar amount and as a percentage of state budgets. We did see states turn to them some during not the Great Recession, during the pandemic. The levels decreased some, but here once again, not nearly to the levels that they decreased during the Great Recession. So states did not turn to rainy day funds to the level where they have in some previous downturns. And we've already seen somewhat of an effort to rebuild rainy day funds in some states. As I noted, most states ended fiscal 2021 with surpluses. So in a lot of those states, they directed at least part of those surpluses to their rainy day funds and reserves. So we're starting to see rainy day funds increase here once again in fiscal 2022. So give a little bit of background on state spending. Most of these slides, or I guess all of these slides, are coming from the state expenditure report. And I also tried to do some comparisons to what we're seeing on the national level compared to how Virginia breaks down their budget. I didn't include the one slide that Leah already included, kind of explaining the breakdown of total state spending. So the largest category of total state spending is general funds, then followed by federal funds and other state funds, and then bonds. The federal funds portion typically grows during a downturn, and we're seeing that as well this time as well, too. And that federal funds piece is going to make up a greater percentage of the overall pie for total state spending. So on this slide, we're looking at total state spending broken down by program area. So this includes both state and federal funds. Medicaid is now by and large the largest area of total state spending, and it's been that way since around 2007 when it overtook K-12, and it's only continuing to grow for numerous reasons. Overall growth in healthcare spending in the economy, the expansion of Medicaid, and now the enhanced FMAP. So we continue to see the Medicaid grow as a percentage. We actually had seen it start to level off somewhat the past few years before the pandemic hit, but now we're likely to see grow again as a percentage of overall state spending. If you compare it to what Virginia's total state spending is, it's relatively similar. Medicaid's a little bit less, and Virginia has some more in that all other category. And a lot of times when you're looking at individual states, it kind of comes down to how states define all other spending and what all they include in it. So, we see some fluctuations among states and how much they consider in that all other category. For general fund spending, so this is spending from state dollars, K-12 remains by far the largest area of general fund spending on the national level. About a third, a little over a third of all state spending goes to K-12, with Medicaid the second piece, if you don't include the all other category. And as far as Virginia, the figures are pretty similar for Virginia. Whereas we see here, once again, K-12 is the largest category. I should note there, kind of sticks out, transportation at 0%. The reason for that, and if you go back and if you look at transportation for the national level too, is very small for general fund spending. That's because the vast majority of state spending for transportation comes from what we consider other state funds, which are funds earmarked for a specific purpose. So in transportation's case, it's mostly gas taxes that are earmarked specifically to transportation. That's why we don't see much of transportation spending in the general fund category. If you look at revenue sources in the general fund, so personal income tax is the biggest category, with sales tax second. There is a lot of variation amongst the states in this. Some states have a sales tax and not a personal income tax. Some states have a personal income tax and not a sales tax. A few states have neither. For example, Alaska has neither, since they're so heavily reliant on the severance taxes. But there has been a push in recent years for Alaska to have either a sales tax or an income tax, since their revenue stream is so volatile. as I noted at the beginning, that both pieces, both personal income taxes and sales taxes, did not see the type of declines during the pandemic over the past year or so as originally anticipated. And if you look at Virginia, Virginia is more reliant on personal income taxes than the nation as a whole, with sales taxes second. So kind of showing the variation of how different states structure their revenue streams, whereas Virginia is very much reliant on their personal income taxes. So looking ahead here, then we should have plenty of time for questions if anyone has any for Leah or I. As we noted, governor's budget proposals for fiscal 2022, if you looked at total state spending, they were anticipating flat growth, whereas they were anticipating increases in general fund spending. That is likely to change as we continue to move through fiscal 2022 and as we analyze enacted budgets for fiscal 2022. With the passage of the American Rescue Plan, you're likely to see greater increases in total state spending for fiscal 2022 as the federal funds have begun flowing to states. As Leah mentioned, states are at different stages of deciding how to best use those American Rescue Plan funds, but we expect more and more states to start allocating at least part of those funds during the current fiscal year. So you're likely to see the federal funds to states increase and overall total state spending increase in fiscal 2022. Revenues are continuing to do well in fiscal 2022. The growth hasn't been as high as what we saw in some instances in fiscal 2021, but as of now, states really aren't facing revenue challenges for fiscal 2022, although a lot of uncertainty remains. The states are closely watching what's going on at the federal level. Depending on what happens in some of those areas, as Leah noted, it could negatively impact state revenues if the debt ceiling increase wasn't re-upped again, if there was some sort of government shutdown, any of those sort of factors, or if the pandemic happened to get worse, if we saw a new strain, if we went back to if not complete shutdowns, going back to where at least some degree of where we were in 2020. All these sorts of things would obviously have a negative impact on state revenues. So states are closely watching that, as well as the overall federal uncertainty. And as Leah mentioned as well, we have a lot of information available on our website, the COVID information that she noted, and also all of our other publications are free to download on our website as well. The State Expenditure Report, the Fiscal Survey of States, and some of our weekly publications. So if anyone ever has any questions about what's going on at the state level, feel free to reach out to myself or anyone else at NASBO. With that, I'll turn it back over.
Thank you so much, Brian. We have a question here from Jamie Doherty of Vita. He asks, are there any theories as to why state financials have held up better during this particular downturn, that is COVID, compared to the most recent downturns, 2002 and 2008 to 9. For example, Virginia's revenues and financial position are about as strong as I can remember it.
Yeah, no, I mean, two main things is because of the size of the federal COVID-19 aid that's gone down to states, that has helped to bolster state revenues. So you saw it both in the direct aid and also the aid to individuals and businesses, things like the unemployment insurance assistance, has helped increase consumer spending and has led to less declines in state revenues. So, and then, really this decline, the economic decline was sharp, but then by and large, the economy quickly recovered. Not getting back to all the levels where it was before, but something like the stock market, we saw significant declines during the Great Recession, and we saw initial declines, but then the stock market quickly rebounded. So we haven't seen high-income earners impacted much, or in some instances at all, during this downturn, where that is something different than what we saw during the Great Recession and also the recession in the early 2000s. We did see high income earners more impacted during those downturns with what was going on in the stock market. And you saw it in their capital gains and other things than what we saw during this downturn. So most state income tax structures are progressive in that they're more reliant on high income earners. Some states are very reliant on high income earners and some are less reliant, but in basically all states, they're more reliant on high income earners than people in the middle and lower part of the economic structure. So that's a reason why we didn't see the revenue declines that we saw in previous downturns.
And this is JoJo. I have a question because I noticed, excuse me, I noticed on one of your slides for one of the revenue categories, it had gaming. And I know when there was a shift to online purchasing, the states were a little bit behind the gun and figuring out a way to tax that. Every time I turn on the TV, there's a new online gaming app. Is anybody looking at that as a source of taxable revenue, or is it just kind of going unmanaged and maybe they'll look at the numbers later and see, gee, we need to look at this?
No, we are seeing more and more states start to do online tax online sports betting since the Supreme Court decision a couple years ago. There's a case related to New Jersey that allowed states greater latitude to tax sports betting. So some states have been more at the forefront of doing online sports betting. New Jersey and Pennsylvania are two states that have seen a fair amount of revenue come from online sports betting. But even this year during legislative sessions, we saw more and more states legalize online sports betting. So it will be a growing revenue stream for most states. However, it's still going to be relatively minor. Even the states that were kind of the forefront of it, it's still much less than what you see with sales taxes and personal income taxes, and even less than corporate. So we're talking low single digits for most states. So, it helps overall state revenue outlook, but it's not, states aren't reliant on it, and it's not nearly as big of an impact as some of those other sources. And that way it's somewhat similar to what we've seen with states moving to legalize and tax recreational marijuana, whereas states are seeing increased revenue from it in states that have legalized it. And most states that have legalized marijuana have seen revenue collections from that come in above projections. It's always difficult when you have a new revenue stream to make accurate revenue projections, but in the instance of marijuana, most states have seen the revenue from it come in above projections. But here again, if you look at the overall percentage of state revenue, how much it's coming from taxing marijuana, it's in the low single digits again, maybe 1 or 2%, if that, and that's probably at the high end for most states. So it helps, but no state is seeing marijuana as one of their major revenue streams, or gambling for that matter.
Yeah, I guess we'd need to be more concerned if we saw revenues from marijuana, taxes, and online gambling at a higher percentage. So,
right. Yeah.
Okay.
Another thing that's held up well during the pandemic was alcohol sales. Even during the beginning part of the pandemic, where we were seeing declines in transportation revenue as people are driving less, and we saw a cutback in consumer spending and some other things. We really didn't see a decline in alcohol sales. So that's one revenue stream that seems to be somewhat recession-proof.